Hello and welcome to the Relax It's Retirement podcast with your host, Josh Leonard, where we talk about transitioning into retirement with intent. I'm Wendy McConnell. We have Pete Belcastro along today, our recurring character here on the podcast. How is everyone doing today?
Great, Wendy. Hey, another great to see you today.
Oh, and
It's
I'm
good to be
so
back
happy to see
with you.
both
It's
of
good to
you.
be back. Yes.
Yeah, yeah. Okay. Uh, what are we going to talk about today, guys?
Well, today we're going to talk about, an awareness about our finances. There's a quote whenever I was prepping notes that kind of stuck with me. The first step towards change is awareness. The second step is acceptance. And I think that that's a big piece of retirement planning or planning for anything in general is being able to gauge where you are today and where you want to go, right? For my bike ride this year, any, sort of physical feat that you're attempting to do, you kind of got to be honest with where you stand to start, right? You don't
Yep.
just go out and go run a marathon or bike 100 miles. You kind of got to gauge where you're starting and come up with a plan to catch you up to where you're at. So today we're going to talk about know what you owe and own. So capturing those debts that you have and the assets that you have and how to better understand how to balance between the two.
Okay, so we actually have a new expense every month. One of us had a run-in with a deer
Oh,
and
the
totaled
deer
their
won.
car. The deer
Oh no.
won. So we got to purchase a brand new vehicle this weekend, and we were car payment free until that moment. So
There you go. And all of a sudden, what you owe is a little more clear. A little.
oh yes, oh yes,
It's yeah. I think whenever we start talking with clients, everything isn't as obvious as you just hit a car or your car just hit a deer. A lot of the expenses and things that happen, it's not that black and white. So the debts they take a lot of different forms, and there's a lot of different things associated with that debt. There's a duration that you have to pay it off. There's interest rates. Understanding what you owe is important.
Yeah, I mean, I think understanding what the debt itself is, right? So this is a car loan, presumably, right?
yes.
You get a car, which is a depreciating asset, and there's interest on that loan. So, they keep extending your ability to loan longer for a car. And I've seen some memes around this that are kind of amusing, like, hey, I loaned this car for 682 months. And you're like, the car's going to be worthless in like 3 years
Yeah.
because you bought a 15-year-old car, right? Like, there's a reality that you need to have with any of your debts. So knowing what the total balance is, your plan to pay it down, the cost of that loan, those are all important factors, and figure out what that timeline is. Like you had noted, Wendy, you didn't have a car payment and now you do. Well, you know what's worse than one car payment?
Two.
Two. So great. Hey, you know what? Maybe, we thought we had two paid off cars. Now we have one. Maybe having a little bit of savings to offset, the next car replacement or slowly trying to build that fund up might be helpful as well to help avoid debt in the future.
Yeah.
Not everyone can do that within their budget, but that's something of, understanding that basic structure.
Okay, so next time I'm buying it straight out. That's what you're telling me?
If you can, it doesn't
Well,
always make sense to do that.
Have you priced cars lately?
I have,
Oh.
and it does now.
Yeah. I think the median price is now 47,000 American dollars.
It's insane.
It's pretty impressive.
Yeah. So, all right. So we'll work on putting a little extra for in case something happens to the other car. But what else should we be looking at when it comes to our finances?
Yeah, I think there's different types of debts, right? So, I mean, we have a car debt, a depreciating asset. Your house is hopefully appreciating, right? It's worth more over time. So that's a different type of asset when we're looking at paying down debt, right? There should be a growing value left after you pay down the debt, not like a car where there might not be much based on the $40,000+ you just paid for a car, right?
Yeah, I always thought that was funny whenever you went and you bought a car or TV, and they're like, you got to protect your investment. I was like, well, typically we want investments to appreciate, and we know that these are depreciating assets, so it's not really a good investment, but they do, but it could be considered an asset that you might want to hang on to if that interest rate is a lower rate, relatively speaking.
Yep.
Yeah, and I think sort of the worst one is credit cards, right? So many times credit card interest rates can be 20% plus. And I think much like car loans too, typically your interest rate is far higher the worse your credit is, right? So the more your need is for that credit card to help fill in the gaps, unfortunately, you're going to pay a higher price for it. So being able to avoid that accumulation on the credit card, or if it has happened through a financial emergency, right? Maybe you needed to, replace the dishwasher or something quite quickly and you just didn't have the cash. If that situation arises, being able to pay that debt down quicker, being able to prioritize those debts to tackle that one maybe quicker than the car payment.
Yeah, so there's we like to try and evaluate the things that you owe. So not only just the dollar amounts, but the percentages. And obviously, if you have a good handle on, what you owe, it actually helps, it helps give you a little peace of mind, So if you just don't know and you feel like you have 100 credit cards out there, you don't know what the interest rates are, it can get pretty stressful, So just figuring out, hey, what do you have out there, before you even consider what to pay off and how fast.
For example, I would probably try and focus on my credit card debt before I worried about paying down the car, because I got a pretty good loan at 1.9%, and my credit card is way more than that.
Right. And the Taylor Swift experience, while it might be killer, the credit card interest is probably more of a killer.
Yeah, well,
You saw how I got Taylor Swift in this episode, too?
Next time you see me, fellas, I will be a bona fide Swiftie. So
Okay.
Wow.
I will be Swifterized.
You will be Swift.
So just be ready for a lot of excitement next week.
I'm ready for it. I'm pumped for it.
Yeah,
if you're too swift, we'll slow you down.
I paid off the concert ticket, though. I did it.
Good.
I think you told us that before. I just had to,
I know.
get that in there.
Hey, since you brought it up, so we can get back to the show now.
Always happy, to talk about the Taylor Swift,
I think though that's usually people understand that your credit cards are going to have the highest interest rates, and it really is the worst debt, and mortgage and vehicle loans might be a little bit better, but everything you can see, obviously, credit card, it's not tied to anything, high interest rate. Vehicle, you can drive it away, kind of in the middle, and that mortgage, that house isn't going to move. So you get the best interest rate. So it depends on what it's secured with, as well. And when we start talking about, what to pay this off, the big issue for all of us is we don't have an unlimited amount of money. So you're dealing with, so what do we, I paid my bills, I'm putting food on the table. You start looking at these different debts, what do you pay off? I usually like to, run a little exercise on, hey, I don't know, Wendy, what do you think if you had like $100,000 left on your mortgage,
Right.
At a 6% interest rate. So I already have this stuff already ran, you'd be paying about $714 a month. So let's just say that on that $100,000, you want to pay it off in 15 years. So you had an option to either put $300 on that mortgage or put $300 towards a savings account. If you put $300 on that mortgage extra, you'd have that loan paid off in 9.5 years. Okay. But if you put that extra $318 that I came up with the difference, in those 9 years, you would have an extra $47,000. So, we start looking is, hey, would I rather have 47 grand or no debt? Well, some people start thinking that, you might want to, if I pay off all this debt first, 9.5 years, I can invest the money for another 4.5 years, and then I'd be better off. And the difference between that would be about $20,000. So I know I'm kind of throwing out a lot of numbers here, and we could maybe link a little spreadsheet to the podcast afterwards. But just a little, I guess the point is it's worth digging into what you're paying with the interest rate and the alternative, what you can do with those funds.
Mm-hmm. Yeah. And I think sometimes we meet with clients and they have an emotional attachment. This is a very common one of paying off the mortgage before they retire, right? Oh, I just don't want to have that as an expense in retirement. And sometimes it doesn't even make financial sense to pay it down, especially if your mortgage rate is at 2.5%. But there is a sense of comfort there. So we can prioritize and say, hey, you know what? You don't even have an emergency fund right now. So if you hit a deer with a car and you need to go make a down payment on a new car, you're going into debt. So let's at least build up that emergency fund first and then look at paying down your mortgage a little bit quicker. Or you don't have enough saved for retirement. So let's make sure we're saving enough for retirement, and kind of having a trickle down effect rather than just being solely focused on, paying down the mortgage, so to speak. We've met with clients in the past too that for years they're retaining a credit card balance, yet they have all the money sitting there in savings. So one, you're paying I think in this case it was like a 12% interest rate on the debt and earning less than 1% on the savings. Okay, let's wipe out some of that short-term debt that's costing you a ton. The house, you have an asset there that you can loan against in the future too. So even if you still owe a little bit of money on the house, but you have more equity and you have expensive home repairs, you could look at a home equity loan, or there's other alternatives there. The credit card, there's no flexibility. You just keep paying more money.
That's right. And locking in those low interest rates, it does have a compounding effect, not only because, 10 years from now will be 10 years from now. So we know that there's inflation, things keep getting more expensive. So that $700 that, that example I gave, that payment, it's not going to be as much, geez, the way things are going, that might be what a Happy Meal cost you in 10 years. But no, but so hopefully that makes sense that, take all these factors into your decisions to make sure that you don't just come up with, a blanket statement, to say, hey, I'm going to pay off this debt or that debt. Make sure that there's some financials behind it,
Yeah. Well, and I think the counterbalance there, which we've kind of teased at, is knowing your assets, knowing what you actually have, and the flexibility around that. Pete and I, a couple episodes back, talked about some client experiences of paying off debts, and they were looking at pulling money from a 401k or an IRA. Well, the tax implications on that are higher. So knowing what you own, those specific types of assets, how they're invested, the tax implications of taking withdrawals from those is something that is key to building your financial plan as well. If you think, hey, I've put all my money in my 401k, and when I retire, I'm going to take a big chunk of that money out to buy an RV to drive around the U.S., well, you're going to be in for a pretty rude awakening when Uncle Sam takes about half of your money. So you want to be careful there and intentionally know what you own and why you're allocating money towards that.
All right. That makes sense.
I think traditionally we've all been coached to kind of put money away in a 401k or an IRA, right? We get a tax deduction today. It grows without any tax implications when we withdraw. As long as we're after age 59 and a half, we pay taxes at whatever tax bracket we fall into. Well, that's good if you're in a lower tax bracket, right? That can be beneficial to you. If you've been a high earner and your lifestyle is going to stay about the same, or you're earning the same amount, you might not actually go down in a tax bracket as much. And if that's your only asset, if you need to take a large withdrawal, you might even bump yourself up into a higher tax bracket. So we want to be careful there. if we have other assets that are allocated maybe after or taxable accounts that are invested in stocks, we need to be aware that those are going to fluctuate in value in the short term. So if it's to buy a car in 6 months, we probably don't want it 100% invested in NVIDIA stock, although it's done really, really well, over the short term. That could change direction pretty quickly.
And if I invested, I can guarantee you it will. start
That's
doing the
well, we
opposite.
got to.
Just like when I get in line at the supermarket, it's always the slowest line.
It can definitely feel like that. That's for sure.
Yeah, I think investing needs to be long term, right? Many times people will buy a stock. I think that's what you were hinting at, Wendy. That like, oh well, if I buy it, then it's going to go down, right? Well, that's because we're in the euphoria cycle. We're really, really happy. This stock is really flying high, and I'm going to make money like everyone else has. Well, when you jump on the bus late, sometimes it doesn't turn out that well. And then if it drops, what would you do at that point, Wendy?
Well, I know from talking to you that I would just keep it where it is, but you would be tempted to sell at that point, but you're going to lose money.
Yeah.
Wow, she passed.
Yeah, that is the cycle, especially in the short term, that most folks do. And we have in our office, we have a graphic that kind of jokes about that you're in a euphoric state, then the stock plummets, you sell, and then you buy again once the market gets high, and you repeat until you're broke, right? And, unfortunately, that's not what you should be doing. So understanding your assets and understanding that if I'm buying stocks, I should have a 7, 10, or even longer time horizon on those assets so they can go through those normal fluctuations.
Yeah,
All right.
going ahead, getting that in your mind ahead of time and being prepared for when these things happen. That's how you stay invested, and you can zoom out. You can take a little bit broader look at things.
Yeah, and I think, another common asset that people will own are bonds, right? If you owe bonds, like in 2022 when interest rates shot up, those bonds decreased in value very quickly. However, if it's a high-quality company and that debt's coming due in 2 to 3 years, you're going to get that initial investment back at the end. That's part of the structure of the bond. So while that price might be depressed in the short term because interest rates went higher, just hang tight here. If you can hold that money till maturity, you can get back that par value or the initial stated value. So many times, again, knowing what you own is the important piece. If you only have 6 months left on that bond, don't be selling it at a loss. Just hang tight for a little bit.
Okay.
I think similar thing is true with like CDs, right? Sometimes we own CDs and we saw a billboard yesterday that said I could get this percent and I'm only getting this. Well, if you're going to pay a penalty to get out, make sure you know what that penalty is and make sure that it still makes sense to you over the long term.
All right.
I think another common one, and this will kind of pivot us into the next section, are life insurance and annuities. So if you're younger, if you're at my life stage or Pete's where you still have kids at home and go figure, they cost money, and maybe you have a spouse that's dependent on your income as well. Life insurance is a great tool, right? It can help cover the mortgage, any education funding, just the cost of raising kids, which is really cheap, right, Pete? Dance is cheap, travel sports is cheap, after school activities.
It's hard to believe people do it. It's
Well, I opted out. I got a dog.
yeah, there you go.
Yeah, dogs are still expensive. I just got a text from my sister today that she's getting another puppy, and I'm like, that's expensive.
I can only afford one. I can only do one. But yeah.
There you go.
Still cheaper than kids.
I think so. Yeah.
There's a reason why you're going to see Taylor Swift, and my daughter went to the theater to see her. That's
Wendy. The other, dogs are certainly a cost, right? I think we've had lots of clients come in and say, "Oh man, I just went to the vet, and it feels like they just robbed you," due to the cost. But a lot easier of an expense track than raising a human.
Yes.
Yeah, and it's definitely tough to think about sometimes, but you know, there are some expenses and things. There's debts that you can put a price to and say, hey, if I'm not here to pay these, it's that's going to be a huge burden on the people I leave behind. So taking accounting for those things, like we talked about at the very beginning.
Yeah, I think that's certainly important. I think, maybe that's it. Maybe you intend to relocate. You're taking out a new mortgage. You want to make sure if you pass away that mortgage is paid off. Hey, can we reduce the cost of paying down that debt sooner by just buying life insurance to fill in the gap? There are lots of planning situations where traditional life insurance fits in. Many times we get the question from clients, hey, I'm about to retire. Like, my house is paid off or almost paid off. Do I need this? And I think then it becomes a balance of, well, do you need it for estate planning purposes, right? There is a tax efficiency to life insurance where you're able, in most cases, to pass on that death benefit tax-free to the next generation. So that could be one reason to retain it. Or are there other benefits that you might be able to get from that policy, like long-term care type coverage? So some permanent life insurance policies allow you to take a portion of that death benefit out each and every year to help pay for long-term care expenses. So if that's a concern, that might be a reason to own. But if the house is paid off, you're not worried about the estate, you have long-term care insurance covered in another way. Maybe you say, hey, I have enough assets. I'm willing to sort of self-insure in this way, and I don't need life insurance anymore. That is something to evaluate, especially when you undergo life changes. So as you're accumulating and starting out, if you have another kid, you probably need more life insurance. As the kids move out of the house is paid off, you probably don't need as much life insurance.
Okay.
Yeah, the more top of mind. Yeah, the more top of mind you keep of that, the more up to date it will be to make sure that you aren't, overinsured if things are getting paid off, you're just not paying attention, or underinsured. If you didn't think of some expenses that might come due here.
Yeah, certainly. I think another one that we commonly get, or that's important to understand if you own, why you own it, are annuities. So, traditionally, I'll say an annuity, like my grandfather's annuity, was something that you put money into for a guaranteed income stream, right? You gave money to an insurer, they took that sum of money, and the trade-off was you got a guaranteed payment for a specified amount of time, or for your life, or joint life if you're a married couple. That works out really well if you live a really long life and you beat the insurance company, so to speak. It doesn't work out well if you give them the money and you and your spouse, or whoever is insured, gets hit by a bus the next day. That was a bad bet, right? It is insurance, and it helps create a cash flow. Now it's like Baskin Robbins. There's 31 different flavors, right? We can have some that are leveraged for the estate, some that help manage market risk, some that are investing in the market via sub-accounts to try to get higher growth while guaranteed income. There's all sorts of different flavors. If you own it, you should know why you own it. If it is for guaranteed income, because that's something that's important to you, make sure it's optimized for that goal. Sometimes we'll sit down with a prospective client and they show us, hey, we have this. We're paying all this money for an income rider, but between my pension and Social Security, I don't really need income. Well, why are you paying a fee for something you don't need, right? Maybe instead we should reposition that as an estate planning tool, or invest it in another way that might benefit you in the long term.
I have a question. So you can't transfer an annuity. Like if the person just gets hit by a bus, like you said, the insurance company keeps that money?
So a traditional annuity, you would have to annuitize the contract. That's where the word annuity comes from, which was turning that lump sum of money into the income distribution. A lot of the newer types now, they'll have what's called an income rider that allows you to take guaranteed income out of the plan. But if you pass away while there's still cash value left in the plan, that would go to your beneficiaries.
Okay.
So it depends on the flavor at this point. Traditionally, it was a pretty simple structure, right? You give money, you receive income. for a specified amount of time or life. And within that, the insurance company is, well, for one, looking at average mortality and betting against that with a large pool of people, right? And also there's a interest rate built into that. So if you're looking at guaranteed income streams when interest rates are higher, locking that in for life is typically more favorable than when rates are lower.
There's a lot, Wendy, and really, so much so that you can tailor things to pretty much everybody. But they should have a goal. We don't just do things for no reason. I was talking to my son; he was doing some math work, and I was like, "Fine, if you could do this watching the football, then we can watch the Steelers game, and you could do your homework." And he said, "It's easy, it's mindless, and I don't think I'm ever going to use it." And I was like, "That's fine. Your mind's working. You're firing some brain cells, so it's okay if you don't use it." We don't take that approach with retirement. It's we like to do things for a specific reason. More like whenever we teach things, whenever we go camping or we go outside, we're learning this knot because it can't come untied in the middle of the night whenever we could get, it could be raining or we could get hurt or, we could get cold. You could even, it could jeopardize your health. So there's a big reason for these retirement plans. So if you just have something just because of an interest rate or it's a duration, there's got to be a why behind that.
Yeah, I mean, I think when we first meet with clients, one of the first thing we do is list out all the accounts, right? Whatever you have, bring in your financial junk drawer, right? We all have that drawer in our kitchen where, I don't know, you got one pair of shoelaces, a paper clip, a binder clip, maybe some matches, a screwdriver, just random stuff. A pen, yeah, hopefully a pen. Maybe to fix eyeglasses, a tiny screwdriver. All that random stuff that doesn't have a normal place. Well, many times that becomes someone's financial plan. So the first step we do is we take that thing, dump it upside down, and try to figure out why you need that. If you don't wear glasses, the funny part is you really don't need the glasses screwdriver in your house. It's a really weird thing to own.
Hang on, guys. You're going to need them.
Well, maybe you just had LASIK. Who knows? Anyway, yeah. Same thing with life insurance, annuities. We sometimes will talk with people and they're very focused on getting money into a Roth IRA, yet it doesn't look like they're ever going to pay taxes in retirement. So why do we need to do that, right? You need to have a purpose for the reason that you're doing something. And many times we hear something on the news or the neighbor said this was a good thing, and we end up just collecting junk in that drawer.
All right, so how do we bring it all together?
Bring it together. Well, a financial plan is the best way. But if you're not quite ready to sit down with a financial advisor, or if you're not working with a financial advisor that's servicing you in that full manner at that time, you could start by listing out your assets and debts and just taking a look at them. Sometimes just by listing them out, you look at that credit card that you've been kind of kicking the can down the road and you're like, okay, I'll just pay it off now. So like anything, realizing where you are today is the best starting point. Just like we talked about, meeting with a financial advisor, someone that can give you some insight into your assets and debts is going to be the key to take things to the next level. So if you're looking at retiring within the next 3 to 5 years, we really suggest you sit down and iron out that plan so you're not continuing to pay for things that maybe you don't need to, or paying too high of credit card fees or insurance rates. Okay, like anything, Wendy, having a plan is the key to success. A full retirement plan isn't just a list of your assets and debts. A full retirement plan is going to encompass an income plan, an investment plan, your tax plan, a health plan to cover things like Medicare and long-term care, and your legacy plan, how to pass everything on once you're done with it. If you're not working with a financial advisor, we are here to help. For listeners of the show, we've put together 7 big retirement mistakes checklist. There'll be a link in the show notes. You can click to download that to see how you're tracking. If you are making several of those mistakes, reach out to us. We're happy to help get you on the right track and get you prepared for retirement. On the next episode, Pete will be on again, and we'll be talking about what kills a bull market, factors that could trigger the next recession. And until next time, Thanks, Wendy. Thanks, Pete. Remember to retire with intent so you can live your golden years with the happiness and excitement you deserve.